Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for the second weekend show of 2025, and this weekend show is going to be very much focused on investing in resource stocks. We're going to talk about juniors. We're going to talk mid-tiers. Going to lay out some of maybe the bigger picture themes for investors to take note of, wondering if this year is going to be as solid as it was last year, and if we could even see some of these stocks provide some leverage to the underlying metals prices, which do continue to be quite strong. Just as a note, please go back through our website, kereport.com, and podcast. Just search the KE Report in your podcast player to listen to our daily editorials from throughout the week and company updates. To kick off the show, we're chatting with Dave Erfle, founder and editor of the Junior Miner Junky. Now, Dave, look, your newsletter very much focused on investing in the resource stocks and not the majors, the mid-tiers, the juniors. You do a lot of due diligence and you are quite selective in terms of the stocks that you follow and that you buy within your own portfolio. In terms of 2025 themes, one thing from 2024 really seemed to be a focus more on the larger stocks. The juniors, man, oh man, still a tough market for them. Do you see that environment changing for the juniors in 2025 where more investors take note?
Yeah, I do. It's time for a reversion to the mean. And basically, the one key missing ingredient that's been absent in as far as the silver and the mining stocks not performing well at all compared to gold is Western investment demand. And the reason for that is that they're still being distracted by, making all this money in AI and in crypto. And what we saw at the end of the year last year was, first of all, we didn't get a Santa Claus rally, which harkens back to the old Wall Street adage, if Santa Claus fails to call, bears will come to Broad Wall. And we now have the January effect. If we have a down January, that'll pretty much give us a reason to believe that we're finally going to have at least a 10-15% correction in the stock market. And that's what this sector needs, right? It needs to start. We need to start seeing these people that have made so much money in AI and so much money in crypto start to rotate those gains into the horribly undervalued and ignored resource stock sector, especially the junior sector as far as gold and silver junior stocks are concerned, because they're just underowned and ignored. And as far as the tax loss selling at the end of the year that happened again last year, I just saw a lot of give up. I got emails from people just like, this is it, I'm throwing in the towel. You saw it in a lot of the charts. You saw it in a lot of especially in sentiment. I think gold stock participation is at like a 17-year low, despite the gold price making 40 separate all-time highs last year. So as far as selling is concerned, I just don't see that much selling left in the gold stock sector. And it's time for silver and the gold stocks to catch up, because if you take a look at silver and you take a look at gold stocks, their charts look almost identical and they're due for a catch-up rally. And if you take a look at the GDX, GDXJ, they ran up to strong 4-year resistance and they've built up this huge base. And I think now they're building a handle of a huge cup from the peak in 2020 to the peak of October of last year. And I think the handle's being built out now. But we need to see volume. We need to see, and that volume is going to pick up once, I believe, once we see some sector rotation. Because that's what we need. We just need interest. We need people to come back into this sector. Retail left over a decade ago, and they haven't returned. And it started with Newmont, right? You had at the beginning of October, Newmont came out with their Q3 results and really disappointed on costs. And that's what started the cascade, right? Because the miners peaked about 3 weeks ahead of the gold price for that reason. And that just took, I mean, that's the bellwether. That's what, if you're going to have retail participation come back into this sector, they're going to start with your Agnicos and your Newmonts and your Franco Nevadas. That's where they're going to start. And when you have the bellwether have disappoint the market that much, and the selling in Newmont is way overdone. I think the valuation here in Newmont is 11% below its net asset value. And if you take a look at Q4, the gold price averaged $2,660, which is $200 higher than Q3. So, Newmont's not going to report until I think February 20th. So I think we're going to still see some more, because if you take a look at GDXJ and silver, they're forming these bullish wedges, falling wedges. And I think it's because if GDXJ became 4% within major support at 32 in GDX and at 40 in GDXJ. And that's major support because that's where they broke out when gold broke out of its cup and handle pattern at $2,100. So that's how undervalued these things are just recently to the gold price.
Well, Dave, when we talk about investors rotating possibly out of U.S. equities into the gold and silver equities, I wonder if 2025, and I ask this hesitantly, is going to be the year where valuations actually start to matter. Because when you look at a lot of U.S. equities, their valuations are at very extreme highs. When you look at the gold and silver stocks, yes, Newmont definitely disappointed the expectations, but they still made a lot of money, and they've also divested about 4 or 5 big projects from their fold, and people expect their Q4 numbers to come in better than Q3. Now, people were jacked up with expectations for Q2 and Q3, and there were still a lot of companies that had problems. But at this point in time, as we start 2025, there's a lot of gold producers trading under their book value. There's a lot of gold producers and silver producers that are still making a lot of money. Q4 was probably still a very good quarter. We'll see the numbers in the next month or so, but could the Q4 numbers be the catalyst to get generalists to start looking at the sector from a valuation standpoint?
Yeah, I think so. And that's basically what I was leading up to, because like I said, the gold price averaged $200 higher, and inflation, although it's still sticky and hanging around, and that's another reason, the bond market is basically calling bullshit on the Federal Reserve. They're lowering rates, and they've all obviously caved on inflation, and the 10 years gone up 1% while they have cut 1%. So the bond market's saying, I'm sorry, but inflation's going to be hanging around a while. And, and this week we got jobs numbers coming out, and, the Fed now and the market's pricing in I think it's like an 85% chance that the Fed's going to hold again next week. But, as far as that's concerned, I mean, the Fed's they're stuck between a rock and a hard place. And now on the day that Trump was confirmed, Trudeau has stepped down, so the Canadian government is in upheaval. So all this is going on, and they're expecting that the Trump's tariffs and his policies are going to be stagflationary, I believe. So I think Trump's sleepwalking into a stagflationary recession. I mean, you had an inverted yield curve for 2 years, and now it's starting to reinvert. And when the yield curve starts to reinvert, that's when recession starts. That's historically what's happened. So the gold price is looking at all this, and at the same time, it's consolidating in this now 10-week bullish symmetrical triangle, with strong support at 2,600 and strong resistance at 2,750. And, it went up 54% without even a 5% correction in a year. So this is just bullish, healthy consolidation, high consolidation before it starts its next up leg. And the gold stocks are just sitting and waiting to be revalued. And I think the mean reversion is going to start happening pretty soon. And I think it'll happen. I think a trigger will be a very good Q4, starting off with Newmont, because last year you had Newmont have that really bad quarter, and that was followed by Barrick having a really bad quarter, and that's 20% of the GDX. So that really hit the GDX hard, and that's what made the GDX start to underperform even the GDXJ. So these things are just sitting there waiting for a reversion to the mean, and waiting for retail to finally come back into this space after leaving over a decade ago.
Yeah, it was Q3 earnings season when everyone was getting excited about the numbers that could come out that actually marked a top in a lot of these stocks, unfortunately. But so, Dave, one other aspect of this sector that we saw a lot of in 2024, even in 2023, was a lot of M&A. We saw large companies go after larger, already developed assets. We saw a lot of small companies merge, which is a good thing, I think. But again, a lot of the takeovers really weren't celebrated and there weren't any bidding wars. Does that change at all in 2025 in your eyes on simply the M&A front?
Yeah, I think so. And a lot of the M&A at the end of the year last year were take unders, and that really doesn't excite the sector very much when you have these long suffering shareholders that really don't make money when a company is taken over. So we need to have takeovers again, with nice premiums where most everybody makes money. That's what we need to see. And I think we are going to see it this year, especially, when the gold price breaks out of this symmetrical triangle, because these symmetrical triangles, they usually break out in the direction of the trend, and the trend is definitely up for the gold price. I mean, after it broke out of a 13-year cup and handle above 2100, I mean, it's only moved up 35%. That's not very much at all from a major cup and handle base. So this is just a pause, and the gold price needs to get back over 2750 first thing. And I think that the next target is, I think the symmetrical breakout target is 3000. That'll really get the juices flowing in the mining sector, and I think that'll kick off more M&A.
Well, Dave, in your own portfolio, you often look for companies that you think would be good takeover candidates for the larger producers. And our friend Rick Rule has famously said many times, you don't want to buy the sector, meaning GDX. You want to cherry pick the sector, meaning looking for those special stories that have the potential to outperform. In your own portfolio, when you talk to subscribers of the Junior Miner Junky, how do you look for those high performance companies? What kind of ingredients do you look for to become the next takeover targets?
Yes, I mean, you basically want to create your own GDXJ, because the GDXJ really isn't a junior index, is it? It's a mid-tier index. So you basically want to create your own, and I've done that with 20 positions. And in my top 10, there's 3 that are now fully financed to construction. And I like the companies that are late stage, that have a lot of ounces in the ground, they have competent management teams, they raise money at the right times, they didn't over dilute. So my portfolio is chock full of companies like this. And I just added another one this week. That's another thing that this tax loss selling at the end of the year and people throwing in the towel did, was it basically brought to my attention a lot of several of these companies on my watch list. One in particular, where a serially successful company builder, mining entrepreneur, has been accumulating stock in this company, and it closed the year 35% below his cost. So I told my subscribers, it's rare that you're able to buy a stock in the open market that was accumulated at a much higher price by these serially successful entrepreneurs and mine builders. They've done it over and over again, made all this money for themselves and shareholders. And this happened about 3 years ago to another company of mine, to another company that I recommended to my subscribers. I said the same thing, like Ross Beatty got into this thing a lot higher than we can get into it now in the open market, and the stock tripled in a few years. So I expect the same thing to happen with this one, at least within the next year or two. So this is what happens, when you get everybody throwing in the towel on these stocks, especially during tax loss selling season at the end of the year, when there's total disregard for net asset value, for what they have in the ground, for what they've done in the past for subscribers. People just want to get out at any price and offset their gains in something that they've made, or they just want to get out, period, because they're so frustrated and they've just had enough of this sector. I witnessed a lot of that in December.
Now, Dave, one thing that actually you and I talked about at the tail end of summer when we were at Beaver Creek, and it's something I want to revisit too, because as much as you're the junior miner junkie, I've noticed even in your portfolio more of a pivot away from the true juniors. So I guess with the whole sector selling off, or the lack of interest in there, is that going down to the true juniors, the true exploration plays, those haven't worked, but you can also get these companies that have better work or better assets already proven for also cheaper prices. Now, that whole concept that we talked about at Beaver Creek was I was making the argument we should just be focusing on these stocks that are already outperforming the market because they're drawing in the capital and they have more than powder to go make something happen. Does that change at all this year? Or again, should we just be looking for what truly aren't necessarily the juniors out there? They are the companies that have capital already and have already, in a way, outperformed the market.
Yeah, I mean, that's what you still got to concentrate on until the market proves otherwise. And it's really not close to doing that I can see here. There's still a lot of these companies that are, having a hard time raising money. And then when they do finally raise money, they don't raise enough to have a significant drill program, a meaningful drill program. So, even if they do hit something, the market knows, the smart money knows that, hey, look, they've hit something. It looks really good, but look, they're out of money and they're going to need to raise money. So let's short the stock or let's sell the stock and we'll get it cheaper later, on a finance and we'll get a free warrant. So that is still happening. And that is not going to change until retail comes back into this. I've said it before. I've called it dumb money. The dumb money is not there to bail you out, meaning, if a less learned speculator sees really good drill results, they're going to buy that, and other speculators are going to buy that and bid the stock up based on the results. We're really not seeing that yet. Sure, you're seeing it in a couple of companies like your Snow Lions and your Newfound Gold earlier, but now Newfound Gold is sold off right back down to where it began. So, it doesn't really make any sense to take the chance on these early stage drill plays yet. But I think we'll know when that changes. And I think that's going to change when you see a breakout in the TSX venture. Something really interesting happened at the end of the year. One of the best performers on the last week of the year, where there was low trading volume, was the venture. It had this huge spike up on the day of tax loss because that's when people buy, right? They know that this is the last day of tax loss selling and this is when to buy. And the venture bolted right up towards 640, and that's a really strong 2-year neckline of an inverse head and shoulders bottom that needs to break out. And once it breaks out above 640 and you start to see some volume, it could really move. And that's when you'll know that, hey, it's time to start getting into some of these earlier stage companies.
Well, Dave, if investors for now stick with the more established companies that at least have ounces defined in the ground, maybe some economic studies in place, how do you avoid the pitfall of getting into a developer that's in that orphan phase that doesn't have any momentum? What kind of news flow are you looking for or catalyst for this year when you're positioned in the company to make sure that it still not only participates with the metal price, but also has some legitimate catalyst as a company?
Yeah, well, you just have to have a lot of patience. You need to get on the phone with them and say, what are your catalysts? What's upcoming? Are you going to have a feasibility study? Are you going to have some drill results you're expecting to be really good? Or make sure that those catalysts are something that's going to move that stock. But like the company that I just recommended to my subscribers, it hasn't even really shown that it's forming a technical bottom yet. But the valuation is so cheap, and like I said, you could get it for so much cheaper than what this company builder who's trying to build a mid-tier producer has accumulated shares at, that I don't mind buying it here and just waiting and having the patience for the retail to come back into this sector, and for there's these catalysts that they got on the horizon, possibly sparking that and bringing more investors into the stock, because the stock is ridiculously cheap. They have a couple of fantastic projects, and you just have to have patience. And you buy a half position, three-quarter position, whatever, and then hope that it doesn't bottom. You want it to go lower so you can complete your position. But if it does bottom right after you purchase it and it starts to take off, you're okay because you got a nice position already.
All right, Dave, we'll wrap it up here. Look, a lot to consider as we are now in 2025. And the fact of the matter is, it's not a bad environment for the resource stocks. I know that not everything is moving higher, and a lot of these juniors continue to struggle, but metals prices are generally higher. And these companies, the majors, are generating some good cash flow. So it's one of those, I guess, again, waiting, but I'm sure a number of investors are tired of hearing that you just need to wait in these stocks longer. As a number of them still, unfortunately, continue to drift lower. It was just a rough end to the year. Still an overly, I think, good year for a lot of these stocks. And now 2025 seems like it should be setting up okay. But again, so many things can change over a year. Again, Dave Erfle, founder and editor of the Junior Miner Junky. Dave, it's always a pleasure having you on the show. Everyone, stick around. We're going to be right back to wrap up the weekend edition.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back to the KE Report Weekend Show. I hope you all enjoyed those first two segments with Dave Erfle, where we focused a lot on the individual resource equities and some of the areas that he sees as potential for this year. Now it's time to shift our focus more on a technical basis, looking big picture at the commodities as well at U.S. equity markets, maybe a couple other markets we will mix in here, as we are now chatting with Dana Lyons, fund manager and editor of the Lyons Share Pro website. Before we get into it, Dana is extending a holiday offer to all of you, our listeners. It's 20% off at the Lyons Share Pro website, where you can follow along with what Dana is trading. To take advantage of this offer, all you have to do is email me directly. My email, fleck@kereport.com. I'll forward you on to Dana, and Dana will extend that offer for you. Dana, I do appreciate that. Now, Dana, I always like getting your perspective on a wide range of markets because, look, you're not tied to any markets. You work with your internal models to dictate where trades and opportunities exist. And since I wanted to focus this show a little bit more on commodities, let's stick to the commodities and get your thoughts on some of the commodity charts, which, look, have done pretty well this week, have done fairly well to start this week, however, ended kind of last year on a bit of their back foot. Let's start off with gold. This gold price has been relatively stable here. Yes, it's off of its highs, but gold has been broadly holding above, let's say, 2,600. But it also hasn't been really back to challenging those highs of about 2,800. What are you seeing in this sideways chart, which, in all fairness, you look at just how well gold did in kind of the last 2 to 3 quarters of last year, it was strong. All of 2024 was pretty strong. So what's this recent action telling you?
It tells me not to do much with gold, all right? We had a nice rally. Nothing gets investors more enthusiastic than prices moving higher. So certainly that created some excessive bullish sentiment perhaps in gold. But for us, we're still bullish on it. It would just take a bit of a pullback for us to consider adding more to gold or GL, the ETF, which we play for gold. So still generally bullish on precious metals, but certainly much more so gold, and then secondly silver, and then thirdly, and a distant third would be copper, which certainly from a charting perspective now hitting lower highs, lower lows, that doesn't play well with us. So right now gold would be, still the clear favorite as far as precious metals are concerned. For our positioning, we're just not looking to add anything up around here.
Well, Dana, what about the gold equities via GDX or GDXJ? Any thoughts there? Because they don't always track the metals. It's sometimes a tale of two different markets here. So how do you look at the gold equities?
Yeah, gold equities, the miners, like you said, there's a couple of different things pulling at the gold equities. You got gold and you got equities. So they are equities. You got the influence from the equity market. You got the influence from gold prices, commodity prices. So right now, you're seeing, which isn't new over the last, in recent memory, to be honest, where the miners are underperforming really the price of gold, and they continue to. We had what looked like a decent breakout some time ago. That didn't pan out, and we've talked about, many times over the years that breakouts aren't necessarily the sure thing that they used to be, decades ago. So you got to play them a little bit differently. So right now we got a little bump over the last few weeks in miners. We're actually trimming a little bit here off of our miners positions. We don't have a big position on. Again, starting to see, at least in the intermediate term, lower highs, lower lows in some of the miners ETFs, which again, not something that's our cup of tea. So this bounced into some resistance in GDX, GDXJ. We're trimming a little bit of our positions there.
Dan, I just find it interesting too. On this Friday, we're seeing gold up, and gold was even up the day before when markets were closed in the US. And the miners, GDX, just really isn't doing much. So as you said, we've seen this recent trend, and it's only a few months long now, of lower highs and lower lows, but that was after about 9 months of higher highs and higher lows. What is a level then on the downside that you would be more concerned about for the GDX chart?
I could easily see trading down to 30, before we'd be interested in maybe from a mean reversion standpoint, trying to buy the dip for a trade. But for us to get really excited again about the miners, we'd rather see some technical progress to the upside. We'd rather start seeing higher highs and higher lows. Then we can be a little bit more maybe strategic or tactical with our entry point. We like to buy weakness, but we want to buy weakness in something that's already established a pattern of higher highs and higher lows, or at least technically on the chart, it's got a technical foundation under it. And right now we're seeing, I see more resistance than support on the chart for most of these miners ETFs.
Well, Dana, we have a lot of people that also follow silver, and you made some comments in relation to silver and gold, but silver and gold have had different charts. Silver, of course, still has not broken out to new all-time highs, but it had a pretty good 2024, had a pretty good fourth quarter quarterly close, a pretty good 2024 annual close. Do you put any weight on that, or when you look at silver, are you looking at it more short term? Put a little more color around the silver setup.
Yeah, like I said, gold would be our focus right now, continues to be, as long as it holds up technically. Silver, again, like I mentioned, the more common now is to see, in the case of breakouts, is to see them pop higher, suck money in, and then just pull the rug out from under them. And that's what we've seen with silver. We saw a really nice breakout in October, and it's been nothing but downhill ever since then. So right now we're kind of at what I would say like a pivot point in the chart for SLV around that 28 level. It's got to decisively get through there for us to consider buying the dips again. Otherwise, right now we're sitting pat and maybe even trim a little bit at this level. We want to see strong charts, higher highs, higher lows, above, good matters of support and pivot support before we think about really adding more aggressively back to these charts, silver, gold, and even the miners. The way I like to play breakouts now is, okay, let it break out, let it pull back towards that breakout point, and then you can buy some. So, late October into November, we were buying some around the breakout point. It hasn't responded yet. So when it doesn't respond, then sometimes you got to cut bait a little bit. So we're doing that here. If it does respond and technically put itself in more constructive position, then we can reassess. But right now, really lukewarm on everything precious metals, except for gold, a little bit better there.
From a big picture view, though, Dana, if we look at, the gold price, boy, oh boy, what a great year 2024 was. And look at how much it broke above that really $2,000, $2,100 level and just exploded higher. Silver, this longer term chart, very different. But if you take out that huge spike in 2010 and 2011, silver really seemed to be capped at right around $30 an ounce over the last decade plus. Now that it's hanging out around $30, over $31, seems to bounce right around that $30 range. Would you make the comment, or is it even something that you could say on these charts that these commodities, or whatever they might be, have largely repriced? They've set up a new, maybe higher floor for their trading ranges?
It's possible in the near term or the intermediate term. Again, commodities in general, I think, are in a longer term bull market right here. But when you look historically, contrary to maybe an equity, which basically has, unlimited upside, generally there's bounds to how high or low, commodity prices are going. So that's one thing you always have to consider. Could there be extreme events that cause, massive moves, to the upside in some of these commodities? Sure. But that's unlikely to be sustainable. It's just like we saw during COVID when oil was trading at what, minus $30 a barrel. I mean, there's going to be short-term gyrations, but longer term, one of the reasons that we do like equities better is that you have more theoretically unlimited upside. And if you're the positions that you're in stop going up, it looks like they're maybe they have plateaued. There are other areas of the equity market that you can look at that might have more potential. So commodities are more bound, I guess, historically speaking, which is why, from a sentiment perspective, I guess from a relative sentiment perspective, I generally cannot get as bullish on commodities as I could, for example, specific equities. The price of the Dow Jones has gone up over the course of time. I know there are long periods, and we might be entering one soon where the price doesn't make much progress at all. But over time, there's theoretically unlimited upside, whereas commodities, they're generally bound outside of, decent cyclical moves like we've seen in gold over the last couple of years.
Well, Dana, having said that there's a lot more opportunity in the equities, and it makes sense just from the historic charts. We still have to bug you about a few more commodities here because we have a lot of listeners that follow the sector closely, and I want to dive in on copper. You mentioned you're the most lukewarm on that compared to gold or silver, but copper, really more than any metal, more than aluminum or tin or zinc or iron or anything, is really the doctor of the economy. It's how people look at economic growth. And for better, for worse, copper is a big focus for a lot of investors. What is your outlook on copper, but also maybe tie in COPX, the copper stocks, and give us a copper outlook and also a copper stocks outlook?
Yeah, similar to the other miners, and copper itself would be similar to kind of the miners. We saw a nice rally, and earlier in the year in copper, and increased, like I mentioned, nothing increases bullish sentiment like rising prices. And when that happens, you get anchored into thinking, okay, copper is going to continue rising, or this commodity is going to continue rising, and everything cycles. And I think you have to get the most aggressive when you have the most, evidence on your side. And to us right now, copper looks just, again, lukewarm on it. It's middle of the road, hitting lower highs now over the course of, the last year or so, just like silver now is of late. So it's hard unless there is some reason for it to be bottoming and a mean reversion type of move back higher. It's hard for us to get too excited until we see more evidence technically or from the charts that inspires more confidence to get more aggressive. Right now, we're not seeing it. We don't have, the necessarily the quantitative kind of inside baseball type models that we do on the equity market that gives us more of an inside look, more of a heads up, more of a less, superficial or surface level type of analysis on the commodity markets that we do in the equity markets. A lot of the market internals, the breadth of market data related to equities, that can be very valuable in giving you a heads up that, okay, maybe a turn is imminent in equities, even though it's not showing up yet on the charts. And we don't have that necessarily in the commodity market. So we're more reliant on the charts. And right now, the charts, again, lukewarm at best for copper and silver related issues.
Okay. Well, let's quickly touch on energy, though, because crude is ending the week strongly. Crude is over $76 a barrel. But I'm guessing you're going to say that chart has been relatively boring as well, because it has been very range bound. But then there's also natural gas. Natural gas is almost up to $4. This might have a little bit more momentum. Does natural gas have a bit more of your attention then?
It does. I try to ignore it because they call it the widowmaker for a reason. And every time I think, okay, there's good evidence for getting long or getting aggressive here, I tend to pay the price for it. So I don't trade it a lot. We are long a small amount of it right now. I would say that certainly the benefit of the doubt is to the upside. But again, it seems it's a very spasmodic type of commodity to us. And we're not going to risk a lot of our clients' money in something that trades so erratically. But if I had to choose, am I going to be long or short? I would be long, but it's just not going to be a big portion of our portfolio.
All right, Dana. Well, thanks for humoring us on the commodity sector and going around the horn. Let's get into U.S. equities, where you've got a lot more data in your quant models along with the pricing data. I guess, how are you looking at it more on a short-term basis when you look at the main indexes, and maybe a long-term basis? Is there any difference between the two views?
I'm glad you asked about the different durations, because we've talked about it. Our main models are of intermediate term duration, which is on the matter of over 2 to 6+ months. So it's funny, as an example of where we're talking about where we can use the data kind of give us a heads up about maybe a imminent turn back. And we talked about this maybe a month ago on your show, that while the indices were holding up pretty well and going into early December, our models, which had also been strong, started to turn lower based on a lot of the market internals, the breadth type of data. And it was unusual for us to see the models turn down, even some of the broader market averages from a chart perspective were still hanging in there. And like I mentioned, that the internal data can give you a heads up that maybe this move is not sustainable. And indeed, we saw, our models gave a sell signal in early December, and you saw the plunge soon after in equities from, if you're just looking at it from a chart perspective, seemed to come out of nowhere. So that's one helpful area that you can glean from a lot of the internal equity market data that you don't necessarily have in the commodities, or we don't use on the commodities. So that gave us a heads up that maybe those moves to higher highs were maybe not sustainable. And we're still seeing our models move lower, so certainly still risk here in the intermediate term. You asked about the longer term, and we've talked about it probably over the last year or so. I see a massive amount of risk in the longer term in equities. So you look at what we call background indicators that measure valuation in the market, measure, for example, market cap to GDP, measures of how much money investors have in the stock market. All these things are pushing historic highs that we've only seen, rival back in 2000, back in 1929 in some of these measures. So from a long-term perspective, these aren't timing indicators necessarily, but they are a measure of how much risk is laid in the market when the market does turn down in the long term. And right now, again, we're seeing about as much risk as we've ever seen in the U.S. equity market from a longer term perspective.
Let's take that a step further then, Dana, because look, I've been reading these articles too that a lot of these indicators that have historically been correct are saying that these markets are overheated and we could be in for not just a shallow correction, but a much deeper correction. While they're not great timing indicators, but considering that a lot of these are lining up and telling the same story, what do you do to trade around this? Where do you take some protection within your portfolio so that you're not completely blindsided by this?
Well, that's why our really the models that feed into our decision making in terms of our portfolio allocation are really on an intermediate term basis. Because you mentioned you can have these excessive valuation or excessive data metrics, market metrics that are historically risky, but they can continue on for a while, for years even, and just get more frothy, more excessive. And you don't want to sit out those markets. You don't want to sit in cash because valuations are high for a couple years and miss out on, especially the end of a bull market can be where a lot of the big gains are made. But you do have to have some sort of objective quantitative mechanism for determining, okay, this market has topped or there is substantial risk in the market or the broad market. The way we like to measure is what is the broader market, was the market at large doing. We want to stay on the side of that market. And when those indicators are pointing lower, then you want to take defensive measures, hedge yourself, get out of the market, go to cash, whatever your defensive mechanism is. But you have to have some sort of a short to what we call intermediate term quantitative mechanism to help you decide that. Because again, like you said, these frothy excessive measures can always get frothier, and you don't want to necessarily miss out on some spectacular gains just because, okay, from a long-term perspective, there's a lot of risk in the market. When the market at large, when the broad market is still rising, we want to take advantage of that until that ride is over.
Well, Dana, speaking of people sitting in cash and missing that potential in the equities, there actually are a lot of people sitting in cash in money markets, maybe record amounts of people. I've heard as much as $6 trillion is sitting in, things that are yielding between 3 to 5%. Now, when you look at that, that really brings into the equation both cash and interest rates. What's happening with interest rates? What's happening with the US dollar? I know you don't like to commingle markets and you look at each one on its own individual merits, but to some degree, interest rates and the dollar are intertwined. How are you looking at those two sectors?
Yeah, they're definitely intertwined. And right now, obviously, both are on the upswing. So that has a lot to say about the United States in terms of maybe the economic prospects, but also on a relative basis versus the rest of the world. We're still in probably the best shape relative to much of the or all of the world, despite some of the major ills that we have fiscally, monetarily. We're still the cleanest dirty shirt, I guess you would say, but certainly from a relative perspective, benefit of the doubt is higher now in the dollar, still higher in bond yields. You mentioned about intermarket analysis or how other markets play into how investors make decisions. And certainly there are various components to how much money is in money markets right now. One component is certainly a sentiment perspective. And I think investors by and large are still pretty bullish. So I don't think necessarily a feeling of fear of risk assets is driving money into the money markets. I do think a lot of it has to do with interest rates going up. So investors have been used to, for a long time, 0% interest in their money market accounts are, bank accounts, getting nothing in terms of interest on those accounts. Now they're seeing those go up substantially more than they have been, and they think that's a good deal, and maybe it is. It certainly can go up a lot more, and I expect interest rates to go up in the long term, as we've talked about for many years or even decades to come. So I think the level of assets in money markets right now on a short-term perspective is probably much more tied to, okay, interest rates bumping up right now in the short term, much higher than they've been since many younger investors can remember. We've been in this zero or low rate environment for a long time. So especially if they're not used to being in risk assets, certainly that looks much more attractive, putting more money into a money market or into some sort of interest yielding instrument. So what can push those out? What can push more money out of money markets would be some sort of a blow off, again, another further blow off in risk assets, which again, hard to time the top of a bubble, the peak of a bubble. That's why I say, despite what the indicators point right now in the near term, I would not be surprised to see one more type of a blow off that sucks some of that money that you mentioned is in money market funds now into riskier assets, because one thing the market does best is forces you to most people to make the wrong moves at the wrong time. And that might still be down the pike before that ultimate longer term top is in effect.
What a nuance this is. Hey, markets close to all-time highs, but so much money in these money market funds. So what rotates where, when? One other market that I want to touch on, currencies, US dollar. Could this be driven a little bit more by investors getting defensive because the US dollar is close to 110 right now?
Yeah, maybe a little bit of a flight to safety there, especially again, currencies are always a relative asset, right? So relative to other currencies around the world, you look at what's going on in this country, and yeah, maybe a little bit more fiscally responsible or monetarily responsible, as crazy as that seems. If you're just looking domestically, you look around the world and, oh man, we're in a lot better shape than a lot of other places around the world, which is a scary proposition. But certainly that seems to be propping the dollar up, although I would not be surprised from a chart perspective. I see a little bit of resistance here in the US dollar. Would not be surprised to see a short-term pullback right now, but certainly the benefit of the doubt would be to the upside right now. One more thing I find interesting, and we talk about intermarket analysis and why we don't pay a lot of attention to it. We like to analyze each market on its own merit. You see you look at what the dollar and gold have done over the last, quarter or so. Generally, if there's one consistent relationship, it's that the dollar and gold move in opposite directions. Well, that hasn't been the case, which is one reason we don't like to rely on that type of thing. But the markets are always changed. We've talked about it a little bit before I came on, how market relationships and the way that markets change from a micro perspective are always changing, constantly changing. It's hard to keep up with that. But the one thing that never changes, which we also talk about, is human nature, sentiment. So from that perspective, that gives us great confidence that eventually the price will be paid for these record high valuations, record high level of investor investment in stocks, record high metrics in the market compared with the rest of the economy. So that piper will have to be paid at some point, even though some people say that this time is different. That's never the case.
Well, Dana, that's a perfect setup for the last asset class we wanted to look at as far as things moving higher and as far as record amounts of speculation. Got to ask you about Bitcoin, the cryptoverse. We've talked about currencies, we talked about gold, but in tandem with both of those going up, Bitcoin continued to surge to new highs last year. It's still near record highs. What's your outlook on the cryptocurrency king?
Yeah, for sure. Another one that's been, again, like you said, moving higher almost in tandem with the dollar, which is interesting. For us, again, we don't have necessarily competitive advantage from the underlying data from the crypto market. It's more or less just off of the charts. And from that perspective, benefited out continues to be higher. We mentioned, a couple months ago that our initial target based on a breakout from that plateau level over the last couple of years would be around 102,000, and we hit that recently and have kind of plateaued there, kind of traded sideways, consolidated, which to us is not a surprise. It's a healthy kind of a reset. If we are going to move higher, you need to lose some of the holders or hodlers, whatever you call them, before you can put another rally in motion. But for now, from a charting perspective, I would say still bullish on Bitcoin right now. Benefit out is to the upside, so we are long a little bit there. And B, I would say similar to the gold versus silver versus copper relationship, Bitcoin is certainly the king of cryptos as far as we're concerned from looking at the charts. Ethereum was trying to keep up for a long time, but now we're seeing Bitcoin hitting clear all-time highs. Well, we're seeing lower highs from a historical perspective in Ethereum. So we are still generally bullish cryptos, and on a specific case-by-case basis, we would definitely be sticking with Bitcoin.
All right, Dana. Great having you on the show. Again, Dana Lyons, fund manager and editor of the Lion Share Pro website. Click that link in the show notes to visit the Lion Share Pro and follow along with what Dana is trading. Everyone, thanks for tuning in to this weekend show. As always, please go back through our website, kereport.com, and podcast. Just search the KE Report in your podcast player to listen to all our daily editorials and company updates from throughout the week, and keep in touch with Shad and I, especially if you're going to be in Vancouver next weekend and into the following week at any of the conferences. We'll be there and always happy to meet up with you. Dana, thanks again for your time on this weekend show, and everyone, I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.